Like other economies in the world and other countries around the world, the GCC countries, including Kuwait, have been affected from the spread of COVID-19 pandemic. They have taken drastic actions, actually, such as social distancing, lockdown, travel restrictions, and curfew to contain transmission. The main impact came actually from a combination of forced business closures, travel restrictions, and supply chain restrictions that have hit the retail, hit the travel and the transportation sectors hard. On top of this decrease in the global oil prices, which is partly triggered by the virus. And as you know, GCC countries heavily dependent on oil in revenues. Also on the market side, the stock markets here in Kuwait followed the global trends, decreased by about 30% in March from its peak in January. Of course, all this have been followed by declining in consumption, a decline in employment, fall in investment. The corporate balance sheet have been stressed actually due to drop in business revenues. Asset prices also fall. All this led to economic slowdown. Also, on the other side, authorities have focused on easing pressure consumers on loan repayment, which have been frozen for 6 months for all affected customers at no extra cost. Actually, this is something they deserve compliment on it, the authorities. Also, the interest rate were cut to 1.5 following multiple cut by the US Reserve. There was support also for salaries and secure minimum income that ensure the cost of living for workers affected by the pandemic. Maintaining stability in the levels and prices of food, medical commodities in local market also was one of the priorities. Now, the current situation, the economy is undergoing partial recovery from COVID-19 linked lockdowns and businesses closures triggered in March. While most of these restrictions had been lifted bit by bit, there was like phases here, phase 1, phase 2, phase 3. Most of the economic indicators also rebounded. Of course, there will be recovery, but it will take some time. Of course, the investors like in waiting. They are waiting what will happen in the next few months, how things will continue. You know, there is panic from continuing of the pandemic. Sometimes you feel it will last for 2020 as well. But there was like hold. Everything is on hold. Even the investors are in hold, just waiting what will happen next. All sectors affected, but for some, the impact was especially large and direct, such as retail, such as hospitality, such as transport, such as recreation and leisures. For example, retail suffered from a closure of malls and shops and social distancing, for example, hospitality such as restaurants and hotels, and there was a fear of consumer hygiene fears. Transport also affected by reduced travel and movement restrictions. Recreation and leisure also hit by reduced spending on non-essentials and also worries over crowd gathering. Also, it is worthwhile mentioning here that tourism has been one of the focus areas of GCC countries' diversification agenda. You know, most of the GCC countries, they have the agenda for diversification, and tourism was one of them. Aviation sector in the region had been an attendant beneficiary from this. So, you know, closure of borders and travel restrictions were one of the first measures taken by countries around the world to curtail the spread of COVID-19. These measures had brought the aviation industry to stand still, as we know, all around the world. But here in GCC, for example, according to IATA, revenue of airlines in GCC region is to decline by about 55% in 2020. The number of flights in the Middle East region as well had reached their lowest point in April 2020, dropping about 92% relative to January 2020. You know, there was a lot of pressure on this industry around the world. So persisting travel restrictions, particularly in international travel, limited capacity flights, quarantine requirements, hesitation of passengers to travel due to COVID-19 pandemic continue to weigh down this industry. The threat also now, there's a lot of talk about threat of second wave of COVID-19 and subsequent lockdown restrictions remain. The airlines are resorting also various measures such as reducing workforce numbers, offering unpaid leave to their staff, focusing on cargo transportation to tide over the crisis. For example, many airlines here in the region, they have trimmed their workforce by about 25 to 15%. Respectively. For those airlines which already went back to work, for example, in United Arab Emirates, was one of the countries, first countries in the GCC. Their airlines went back to work, such as Etihad Airlines. They are now offering like COVID-19 insurance to their passengers and to try to boost the demand on their services. Yes, airlines and airports and tourism in general witnessing to strict safety procedures that would help restore the consumer confidence. Now it is allowed for Kuwaiti to go back and forth. For non-Kuwaiti, it is allowed to travel, but there's some restrictions when you want to come back. It is different from one country to another in the GCC. In, for example, United Arab Emirates, it is open to go back and forth. Kuwait closed all public and private schools as well as higher education institutions in the very beginning due to the COVID outbreak. Then they reopened for 5 to 6 weeks to make up for the remaining period of the second semester. The decision was taken as part of continuous follow-up on COVID-19 development. After that, the authorities sought to maintain the continuity of education, and they developed a distance learning plan to keep pace with the modern era developments. The authorities then decided that all classes will be continued and conducted online for the first semester. Now we already started the semester. We are doing it online. We will continue till January, and then they will revisit the decision in November to decide for the spring. You know, teaching online was a complete new experience for a lot of us. The teachers find themselves in a situation that they are obligated to move their classes online right away without having additional training, actually. And they have to use like numerous digital tools to deliver e-learning. You know, some people, they hate technology. They don't like to use, especially old people. So many schools and universities as well, they were not prepared for moving classes online. So the burden is put on teachers to adapt themselves and their students to a new way of learning. But of course, we received actually unlimited support from our institutions. I'm talking at least about my institution, American University of Kuwait. They supported us to large extent in this experience. It was hard experience for all of us, teachers, students, management also. Now what I feel, it is better as the students start to adapt a little bit, and actually we start to adapt using the like learning management system and other digital tools, we feel more comfortable. There is big difference between teaching online and teaching on site. Being in the classroom, interacting with the students, you got used on the instant eye-to-eye contact, communication with each other, like allowing reacting together, sharing experience, making sometimes non-verbal contact, strengthening the social skills when you contact with somebody face-to-face. At the end, education is not only about gaining knowledge, it's about the interaction between students and teachers. Online education posed more responsibility on teachers. Now, it is not only to provide e-learning, but you have to support students, you have to stay connected, you have to show your students you are open to communication. Now, teachers play a big and responsible role. The world is changing in quickly. Today's crisis, a pandemic, has opened the door to new opportunities, put us a new experience, achieving a new standard of online learning. But at the end, I think together we will be able to get a handle on the mess and make it a successful experience. Yeah, of course, this is one of the things that you think of as investor actually, and especially that now the future is, I think the future is for online business now. So a lot of people, they are online. They spend most of their time online. I think there will be this shift, and there will be also entrepreneur and investors that they will be interested in this new segment of business. So yes, it is like it is open, and a new idea is there to discuss. My experience with US stock market start about 1 year ago. Actually, I can say with confidence that US stock market one of the best places to start investing, but you have to do it the right way. Investing in stock markets is simple but not easy, as Warren Buffett said. Investing is simple but not easy. The key is to be educated, to be an intelligent investor, understanding what's going on around you, understanding the historical trends and best practices. All these elements can make the difference between failure and success. In the world of investing, to be successful, I think you have to have a macro view and micro view. What do I mean by macro view and micro view? By macro view, you have to know what's going on in the economy, and you have to understand how it will be reflected on the market. What's going now in the US economy? The Federal Reserve balance is getting bigger and bigger. Maybe it's going infinity, nobody knows. But if we check the numbers, the Fed asset, I will share with you a few numbers just to see the difference. The Fed asset worth 870 billion on its book in August 2007. This is just before the financial crisis in 2008. And the same stood at 2.2 trillion at the end of 2009. In March 2020, 4.7 trillion. And in June 2020, it is 7 trillion. What does this mean? It means the Fed is greatly increasing the amount of bond and other assets they own in effort to keep the market and the economy stable during the crisis. As we know, unlike businesses, the Fed can expand its balance sheet by printing as many as dollars as they want. So it's like creating money from thin air, as they say. So the Fed now, what he's saying we will do anything to save the market. Actually, the market, the stock market witnessed in March 2020, it is down about 30% just in 20 days. And also it saw about 50 trading days in history within the Standard & Poor's rallying 38% from March to June. How this situation is similar to what happened in 2008, because there's a say, the history repeats itself, but if it doesn't repeat itself, at least it rhythm. So what happened in 2008? The recovery of the economy in 2008 came from quantitative easing. The chairman at that time, Mr. Bervann, did everything to bail out the economy to stop another Great Depression, as he said at that time. So in order to not let the economy to go into depression. At that time, the stimulus was about 700 billion. After that, he kicked off years of quantitative easing that eventually pushed trillions of dollars in the of liquidity in the system, and it worked. What we have seen in the last 10 years, this stimulus, it becomes the cornerstone of the longest bull market in history. In the last 10 years, from 2009 to 2020, the market was in bull position. So, and what was the result? Increase in asset values like stocks and housing and whatever. Now it is all happening again, but the fuel is coming from new leader, Mr. Jerome Powell. Powell took over in 2018, and when the pandemic or COVID-19 stepped into, he jumped into action. In a quick move, he reduced the interest rate to zero. They are pumping trillions of dollars in the financial system. Apart from the details, we don't need to understand them inside out. All we need to know that money now is cheaper than ever. And the Fed is pumping more cash into the financial system than ever. And this is the recipe of massive asset boom. I want to be clear here about something. I'm not saying this is good. It is not good. The long-term consequences could be severe, but simply we cannot know today. We don't know if or how it could go wrong, but what we know is likely the benefit on the near term. There is 6 to 7 trillion of fuel, and it's already working. Stocks have soared since the Fed moved into action in March. And more importantly, investor psychology is starting to change. Retail investors are starting to get bullish. Yes, things is changing now. My view, I'm always so positive about this long-term outlook of the stock market. There is historical evidence, base evidence, that stocks usually produce best possible long-term return compared to other assets. That's why you find now a lot of people investing in stock market, and especially US stock market. A lot of people from around the world, they are pumping money in the US stock market. When it comes to investing, actually, no one can predict the future, but even the best expert in the world, they cannot predict the future and the short run. In the long run, you can predict a little bit, but in the short run, even the best expert, and we have seen Warren Buffett seems to have sold his entire holding of airlines. We heard about it. Airline stocks at the worst possible moment, just before it rallied again 100% during the pandemic. So no one can give prediction about the future, but there are like probabilities. This is the macro view, which is you have to understand what's going on in the economy and how it will be reflected on the market. On micro view, investing is not about buying a stock and wait it to go up and that's it. No. You have, if to be a successful investor, you have to have a plan. You have to know what is your investment philosophy. You have to know the difference between trading and investing. You have to know how much risk you can afford, your risk tolerance. First, you have to understand what you are buying. There are a lot of opportunities in the stock market. There are a lot of great companies, but you have to know, you have to select the right one. How you do that? First of all, you have to be interested in the business of this company. You have to like this business. You have to like what this company is doing. Is it aligned with your values? Is it aligned with, it has meaning to you? How this company, they are making their money. This is very important. How much free cash flow they have. It is also good to look at the company which they have competitive advantage. Which is durable competitive advantage. It is difficult for others to compete. Then you have to look at the numbers. at the balance sheet, at the income statement. You have to be able to read the numbers. You have to know this company, what's the return on equity of this company for the last 5 years? What is, how much the debt? You have to stay away from companies that have high debt, for example. And the beauty of the stock market that you have options. If you are that type of person, you don't like the analysis and looking at the numbers, and you can invest in the stock market index. If you invest in a Standard and Poor's, any index, fund index related to Standard and Poor's, from March till now, it is up about 38%, just by investing in the index without the hassle. You know, the index consists of, they are investing like percentage in each company. They have like collective of companies, and you can do it without the hassle. We are, as a human being, we are emotional. We scared. We have this fear and greed. You know that there is a study of 70,000 investor portfolio showed that in 2016, investor return lagged the market about 7%. This means what? It means the average investor made about 5%, Standard and Poor's made 12%. Research from Delabar company, it's a very well-known company, completed a study in 2015, showed that average return for the investor in the last 20 years was 4.5%. On the same period, Standard and Poor's make about 9%. This, what caused this lag or this it is all about the emotion, about the behavior of the investor. We are, as human being, we are emotional. We're watching the news, we're reading the investment news, we are afraid, we want to act. Market itself, it has no behavior, but we are, as investors, or we are as human, we have this reaction. We buy at high price and sell at low price. We have no patience. Or if we don't invest at all, we wait on the sideline. But what are the other options? If you don't invest in stock market, for example, we don't have many options actually. Real estate, for example, it needs a lot of capital. Maybe you cannot afford it. If you leave your money in the bank, the saving rate now horrible. They give nothing. So yes, there is a risk if you invest in the stock market, but most people need to take time and think to consider the risk of not investing in stock market or not owning a stock in another way. To be successful, you have to do what is the psychologically impossible. You have to manage your emotion, and this, I will be honest here, it will not come easy. It needs a lot of experience. You cannot, if you start investing a few months ago, or you will not recognize this. You will learn it through the years. This is, yes, especially true with investor, because you know that we are controlled by greed and fear as human being. Most people, they chase the money, they chase the dollar, they want more and more. Yet when they start losing money, they become scared and freezing up. vast majority of people, they do it the wrong way because of the emotional sentiment on the market is greed. That control us is greed. Thank you very much.